Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about SoFi Technologies, Palantir Technologies, as well as Neostock. In this video, we will be performing some analysis on 4 articles, to where the first one is titled, Investors in SoFi Technologies have unfortunately lost 29% over the last year. We'll also be talking about how over the last 3 months, SoFi Technologies' SoFi stock has surged by 24%, and how I think their overall predictions and analysis is actually incorrect. After that, we'll move on and talk about Palantir Technologies, ticker symbol PLTR, regarding how as artificial intelligence continues to become more trendy, this is going to benefit Palantir Technologies PLTR stock price. We'll also be looking at their future forecasts to predict where their stock price is headed in the future. After that, we'll move on and talk about Neostock and why Neostock is a risky bet that is set to surge. Meaning that yes, there is high risk for this company, however, the reward is even higher. Then lastly, we'll discuss what analysts, professionals, and experts say about this particular company. So for more videos just like this one, and if you want more stock analysis on SoFi Technologies, Palantir Technologies, or Neostock, remember to go and annihilate that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's jump right into today's stories. The first company we're going to talk about is SoFi Technologies, ticker symbol SOFI, ticker name SoFi. And like I said, SoFi's SOFI share price has surged by around 24% over the last 3 months. SoFi Technologies right now is not profitable. However, companies that are not profitable are anticipated to grow their revenue every year at a very impressive growth rate because investors want safe companies that are aggressively growing their overall revenues if those companies are not profitable. And thankfully, SoFi Technologies has seen a revenue growth of 55%, which is absolutely amazing. However, where I disagree with the author of this article is their future projections. For instance, if you see on screen, you can see their revenue in blue, their earnings in green, their free cash flow in red, and their cash flow from operations in yellow. However, what I don't like about this is that they don't have positive earnings for SoFi Technologies until mid-2024. However, based off of the most recent forecasts and data that I've looked at, we know that SoFi Technologies is anticipated to become profitable on an earnings basis at the end of 2023. So I do not agree with their overall prediction. So I really don't think this is an accurate chart. But apart from that, we know that SoFi is positioned very well right now, considering that they have had more insiders buying their stock. Mainly, their CEO is buying up more shares because he believes the company is undervalued. Now, investors need to understand that the company is going to be very volatile in their stock price because of macroeconomic factors. The share price is not just going to go upwards from here. If anything, we can look forward to Q4 of 2023 for these very positive results, and that's when the company will start their upward growth trajectory. But until then, the company could downtrend until these actual metrics are solidified due to an earnings report coming out. But it is good to see how insiders are buying up more of this company, and if you are new to investing, you really should stay away from singular risky growth stocks, which are normally the stocks I talk about. You would need to build a core to your portfolio by investing into ETFs, index funds, or mutual funds, such as VTI, for overall stock market growth that is going to give you stable returns. You could also invest into SCHD, which is a very great dividend-yielding ETF with very fundamentally solid companies. And then for growth, invest into QQQ, which represents the NASDAQ 100 for technology information systems, as well as other great growth companies. So here you get stable returns, fantastic dividends, and very aggressive growth. This should make up, or ETFs like these, or mutual funds or index funds, should make up the majority of your core holdings. And a core holding should make up between 50 to 80% of your overall portfolio. I do talk about this often in my other videos, but you really need to understand that investing is a long-term game. This is not a get-rich-quick scheme, despite what other YouTubers are trying to feed you. For me personally, I have close to 70% of my money invested into my core ETFs, mutual funds, and index funds, while SoFi Technologies specifically makes up around 4% of my portfolio because I don't believe investing more than a 5% portfolio allocation to any singular risky growth company. But I would love to hear your thoughts down below on your favorite ETF and tell me what your average cost basis is and average price is for SoFi Technologies because I would love to know. Up next, let's talk about Palantir Technologies. And Palantir Technologies is a big data and analytics company that focuses on serving government agencies as well as commercial enterprises. Palantir Technologies continues to attract investors due to their amazing analytic capabilities in which Palantir Technologies can analyze and number crunch large data sets to where they can present a company's management with the best data-driven decisions to make to optimize revenue, earnings, or cost savings. Thankfully, there has been a huge resurgence in artificial intelligence and machine learning, which is drawing more eyes and investors into Palantir Technologies. The CEO of Palantir Technologies, who is Alex Karp, even commented that since artificial intelligence is booming right now, the interest in Palantir Technologies has increased due to this. Investors know Palantir Technologies best, most likely from their Gotham platform, which helps large government agencies. They even helped the CIA find Osama bin Laden. So giant government agencies like the FBI, the CIA, the DoD, and many others use Palantir's Gotham platform. However, I'm more excited about their Foundry platform, which applies to their commercial sector, which I think will eventually take them profitable because the commercial sector is actually bigger and has a better chance of bringing them larger revenues in the future than their government segment. Now, despite the $1 million cost per month for commercial enterprises to subscribe to the Foundry platform, their United States customer count grew by 79% in 2022, and we are still seeing growth from this segment even till right now, which is very good. But now let's talk about some of their financials. Palantir is profitable. They achieved profitability in the fourth quarter, and with net income of $33 million, we can anticipate that they will continuously scale their profitability. Overall, Palantir is a very risky company, and I don't expect them to have very good growth over the short term. But over the long term, meaning the next 5 to 10 years from now, I do anticipate the company will scale quite nicely, but in the short term, the company will be very volatile, with the share price going up and down very dramatically. But the best part for me about Palantir is that they are a profitable company right now, and for 2023, they are anticipated to bring in an entire year of profits, which is going to be absolutely phenomenal, which should invigorate investors. So overall, I would say that this is a pretty positive news update for both SoFi Technologies as well as Palantir Technologies, but I would love to hear what you think of Palantir Technologies down below. My personal opinion is if you are only in this company for the short term and you want to get rich quick, then this company probably isn't for you. But if you are a long-term investor that wants to nibble at this company, then this is the type of company that you could add to your portfolio, but always make sure to do your own research. Next, let's talk about NIO Stock, which is an electric vehicle company that's located over in China, and they are extremely risky. So why would we look at this company? Because you all know me, I am extremely risk averse. My portfolio is extremely safe, which is why my portfolio has very stable growth and I get a lot of income for it. But why would a company like NIO Stock be a part of my portfolio? NIO right now currently makes up around 3% of my overall portfolio. So I'll tell you why. NIO, like we said, is an electric vehicle maker located over in China, and it has established itself as one of the top competitors over in China. The three big names over in China besides Tesla would be BYD, Li Auto, and then NIO. However, I think NIO has a great growth trajectory because comparatively, they are trading at a cheaper valuation than the other two companies that I mentioned. After the second half of 2023, NIO is currently projected to double their overall sales for the year, meaning that once this happens and their earnings report comes in, which reflects this phenomenal update, we can see the share price absolutely surging upwards, at least temporarily, and I suggest investors should take advantage of that. Many investors, though, are wondering if NIO stock is still a wise investment, considering the overall general political environment, and that is something that you do need to be aware of. If anything were to happen geopolitically between China and the United States, or China and any other countries, this could negatively impact NIO shares. On top of that, you are investing into a foreign company, meaning you have to invest into ADR shares, which is a shell company, and there are various regulations over in China that the United States doesn't have to worry about. So overall, NIO is a very high-risk investment, but I do think the reward could be worth it. We have had very good updates from NIO considering that they did enter into a partnership with the Norwegian smart energy company named Tibber. If you don't know, NIO has very effectively infiltrated the European market over in Norway, Germany, and a lot of other European nations. So NIO has expanded outside of China, and it seems that there is great demand for their overall vehicles and services. According to Chartmill, NIO is expected to demonstrate a significant increase in their overall earnings per share. Get a load of this. Over the next 5 years, NIO's earnings per share are projected to jump by 27.95% every year. That's a CAGR, which stands for a compounding annual growth rate of 27.95% for their earnings. That's insane. Also, over the next 5 years, their revenues on an average basis are supposed to grow at a 37.68% clip. That is higher than both SoFi Technologies as well as Palantir Technologies. So if these current projections are true, NIO stock is extremely cheap right now, which is why many professionals say that right now is a buying opportunity for NIO, but again, there are major risks for this company, so I would not invest too heavily into this company. So let's see what experts, professionals, and analysts say about NIO shares. Should you buy NIO? Well, according to Wall Street analysts, they say yes, you should invest into NIO and buy this company. When deciding to buy foreign companies, or even domestic companies, investors normally turn to analysts, financial reporters, professionals, or other types of commentators who have very strong portfolios. NIO right now currently has an average brokerage recommendation, also known as an ABR rating, of 1.94. Essentially, an ABR rating ranges between 1, which is the best, meaning this company is a strong buying opportunity, to a 5, meaning that this company is a strong selling opportunity. And considering that NIO ranks at a 1.94, this gives us a buying opportunity. So out of 9 professional brokerage firms, they rate NIO very favorably, which is very good. However, please don't go investing just based off of an ABR rating or what analysts say. You need to always make sure to do your own research. You need to ensure that this company is good for your personal portfolio, because even you and I have different strategies for our portfolio. I am a hybrid growth dividend investor that focuses on stable growth regardless of the stock market environment, which is also why my portfolio performs very well even during recessions or pullbacks. At the end of the day, all 3 of these companies are risky singular growth stocks. Please focus more on your ETFs, index funds, and mutual funds, especially as we enter into a time of more stock market volatility with the potential chance of a recession coming. So remember to hunker down your portfolio, weigh your risk to reward very well, do your own research, and with that being said, I will see you in the next YT video.